Hi, Manjula.
Shan, can you hear me?
Yeah.
Okay. So we are going to be in a separate group and then we'll be transferred to the larger group.
We already started the webinar. We are not in the practice session.
We are all in one group, is it?
Yes, yes.
Hi, Shiran, can you hear me?
Yes, sir.
Okay.
Okay.
Is it screen the wrong way?
No, it's correct. It's correct.
It's correct for you. Okay.
Yeah.
Okay. The opposite.
That's fine.
Jayamavate Malvasan in සෙවනැල්ලමෙන් නිරතුරුව ළඟ හිඳිනා අපේ ජය අපේ පැතුමයි ලබැඳියාවෙන් සහය සදනා.
Welcoming all of you with warmth and care. Commercial Bank. Our interest is in you.
In the ever-evolving world of business, Mac Holdings Private Limited has demonstrated its ability to adapt to changing customer needs by providing innovative and customized solutions. Today, we are one of Sri Lanka's most respected, diversified conglomerates with a presence in shipping, strategic investments, aviation, hospitality and leisure, renewable energy, freight and logistics, fisheries and aquaculture, and more. We have been able to expand our presence in the region, providing unmatched expertise, the highest quality and an excellent service. Our remarkable growth is driven by our innate ability to reinvent ourselves. Mac Holdings, we cannot spell success without you.
Good afternoon, everyone, and a warm welcome to this webinar hosted by the Ceylon Chamber of Commerce in collaboration with the Council for Business with Britain on navigating the crisis. As everyone is aware and is presently going through it, Sri Lanka is going through one of the worst crises it has ever seen and still ongoing. So the Chamber has brought together leading economists to explain to you more about the crisis, what are some of the remedies that are kind of taking place at the moment, and also what the private sector should do, in particular in navigating the challenges that are before us. So we have a stellar lineup of resource personnel. We have Dr. Indrajit Kumar Swamy, who will be delivering the keynote, following which we will have a panel discussion with Murtaza Jafferji, with Daniel Alphonsus, with Dr. Roshan Pereira and Amal Sandaratna, which I will moderate later on in the program. So let me now invite our CEO and Secretary General, Mr. Majula De Silva, to give some opening remarks and set a bit of context as we start off today.
Thanks, Shiran. Can I be heard?
Yes, Majula, you're good.
Okay. So good evening, everyone. Welcome to this webinar titled Navigating Through a Crisis, organized by the Ceylon Chamber of Commerce in association with the Council for Business with Britain, CBB. We are having this webinar in the middle of an unprecedented economic crisis, which has now transformed into a political crisis as participating in this taking on your mobile today we will focus on economic crisis in mind that political relief also a key to the country out of this economic crisis. During this webinar,
Majula, I think we lost you and your line was breaking up. Are you there? we seem to have lost Modular on the call. Let's give a minute if we can. That's fine. Hello.
Sorry.
Can I be heard now? Sorry, there was a
Yes,
connectivity
Modular, go
issue.
ahead. Yeah.
Right. Okay. So these are the conditions under which sometimes we have to carry on these days. So please excuse and let me carry on. So we have 4 issues that we have listed to be taken up today in this webinar. So firstly, what does the economic outlook that is unfolding today and the debt restructuring process mean for the private sector? So that's one aspect we are going to look at. How will the rising cost of living and rampant inflation, which we are currently experiencing, impact the consumer and also pricing of goods and services? So that will be a topic of relevance to most of our participants joining from industry. What structural reforms should be part of the IMF program? So this will be dealt with, I believe, by Dr. Kumaraswamy and others in great detail, and will be another important area to focus on. Plus, how should the private sector plan to adapt to or mitigate the current challenges? Because these challenges are not going to go away in a hurry, and we know that no matter who's actually in charge of the government, we are going to go through a very painful process of recovery, and which means for at least the next 6 months or so, we are going to go through many challenges as we are experiencing currently. So then how should the private sector adapt to these? How should we cope with all this? Will be also dealt with particularly during the panel discussion. So we have as our speaker today Dr. Indrajit Kumaraswamy, former governor of the Central Bank of Sri Lanka, and who's also currently an advisor to the government on the IMF engagement and the debt restructuring process. He will speak for about 40 minutes, and thereafter we'll have the panel discussion with Murtaza Jafarji, Amal Sandaratna, Dr. Roshan Pereira, and Daniel Alphonsus, moderated by Shiran Fernando. Also, let me take just a minute or two to explain to you what the Ceylon Chamber has been doing in the last couple of years to, if possible, prevent this kind of crisis from developing. So that's a question that is often asked. Did the chambers try hard enough? So let me briefly respond to that. So when the tax reforms were introduced in late 2019, early 2020, we immediately called for the reinstatement of the PAYE system, the withholding tax system, and wanted the threshold for VAT payments, which was raised substantially, to be brought down to the level where it was. Because we realized, that these are going to have severe repercussions on government revenue. Then also, as the COVID-19 pandemic broke out, in our immediate reaction that was submitted in March 2020, along with many other chambers under the Joint Chamber banner, we requested the government to engage with the IMF and to make use of facilities that were available to member countries at that time. But unfortunately, no action taken. And subsequently, towards late 2021, acting on the advice of many independent experts, such as Murtaza Jafarji, who's on our panel today, and Dr. Nishan Limel, we started advocating that we commence a preemptive debt restructuring process as quickly as possible in order to prevent a hard default and a shortage of currency to meet essential requirements. So this also repeatedly we have been mentioning since then in all our statements, in all our submissions. In addition to that, we also recommended a liberalization of the exchange rate and a hike in interest rates at a time when these could have been done without a very sharp adjustment, as we later experienced when they were finally done after a lot of delay. So I just thought I will make use of this opportunity to let you know that we have given the right advice throughout this period, but unfortunately, when it is not taken, there was very little. So that's to update you on behalf of the Ceylon Chamber. And on that note, let me pass you back on to Shiran, our Chief Economist, to take the proceedings from here. Over to you, Shiran.
Thanks. Thank you, Manjula. As I explained earlier, I think we will now have a keynote speaker who will, Dr. Indrajit Kumar Swamy, a former central bank governor, who really needs no introduction, has been speaking a lot about what's going on, even post leaving the central bank as well. Unfortunately, due to an urgent meeting, he is not able to join with us live, but we do have a recording of his keynote, and in case he is able to join in live, we can definitely, towards the end, have any questions feeding into him as well. So we'll have the recording going now, and then do send in your questions through the Q&A box, which we will take up with the 4 panelists at the end of the keynote speech.
And basically, for each decile, what the number is.
Murtaza, if you can go on mute. Thank you.
Good afternoon. Let me begin by thanking the CCC for inviting me to speak to you this afternoon. It's a great pleasure to be with you, though I'm talking to you remotely from London. I hope everybody is keeping okay and is safe. What I'm going to do this afternoon is to first start by talking a little bit about the genesis of the current crisis. Kind of go back almost 7 decades to trace how we have got to where we are today. Then identify 5 key challenges that need to be addressed almost immediately. And finally, draw some lessons from our experience in terms of getting to where we have got to. On the genesis, as I think I'm sure many of you have heard me say before, the origins of the crisis can be traced way back to the 1950s. And in my view, the primary cause for Sri Lanka's regression from being the second most advanced country to Japan in Asia at the time of independence to where we are today is macroeconomic instability. And the primary causal factor for that macroeconomic instability over the years has been the government's fiscal operations. Right from the beginning, the government's budget has been the main source of instability. In fact, Professor Joan Robinson came to Sri Lanka, the Cambridge academic, came to Sri Lanka in the late 1950s, I believe. And she said that it was Ceylon then, you Ceylonese have eaten the fruit before you planted the tree, i.e. we were living beyond our means. And Joan Robinson is not some neoclassical economist. She was a left-leaning economist. She was an expert on China. And even someone with that background felt that we were living beyond our means way back in the late 1950s. And that has not changed. Basically, that has been the problem. So that is right through, the problem has been that. But we got away with living beyond our means. 16 times we went to the IMF. We were a bit of a donor darling for much of the time when we were a low-income country and were able to attract high levels of concessional foreign aid, which helped us to tide things over. But despite that, we never really disciplined our fiscal operations, and it was a constant source of instability in the system. And again, I'm sure, as many of you would have heard me say before, it was the result of a toxic combination of populist politics on the one hand, and an entrenched entitlement culture on the part of the people on the other. And they kind of fed off each other in a kind of negative feedback loop, and constantly kept pulling us backwards. But we got away with that problem when we were a low-income country, because we got lots of, as I said, we were a bit of a donor darling. We got lots of foreign aid on very concessional terms. And that, combined with support from the IMF, helped us to get through. But the picture began to change qualitatively once we graduated to middle-income country status, because the concessional money, and it was highly concessional money, right? Interest rates or administration charges below 1%, maturity of 40, 50 years. So we moved away from that. And over time, had to rely more on markets. This happens to all middle-income countries, and relying on markets is in itself not a bad thing, but you have to be disciplined enough to be able to cope with such a relationship. International capital markets impose discipline. Rating agencies which work around the international capital markets also impose discipline. And unless one internalizes the discipline that is imposed by rating agencies and capital markets, one runs into trouble. And that's what happened to us. Essentially, around 2010, when we graduated to middle-income country status, we had negligible amounts of commercial borrowing. So we had quite a lot of headroom in terms of what we could do. Plus, on top of that, at that time, after the global financial crisis, the major central banks were flushing a lot of liquidity into the system. And there was money looking for high yield in the global economy. And we were able to take advantage of that. And we were able to borrow in the form of international sovereign bonds. However, what you have to do if you go down that road is to make sure that you maintain your rating at a sufficiently high level to be able to access those markets, to be able to roll over that debt. And you also have to be careful that you run a primary surplus in the budget so that your debt doesn't keep ballooning upwards. We managed to run a primary surplus in 2017 and 2018, but again, we slipped backwards from 2019 onwards. But that is what we needed to do, which we didn't do. And that is really the background, the genesis of the problem. Now, the more proximate causes for the crisis, that background I have given you is what has been there now for decades in terms of the fiscal unsustainability. And that fiscal unsustainability has led to a buildup of debt. And on the other side, we've had trouble in terms of our balance of payments, the current account of our balance of payments, which has been in persistent deficit. So we were the classical twin deficit country. I've always felt that the underlying problem was the fiscal deficit, because the fiscal deficit and the excess aggregate demand that it pumped into the system meant that we tended to be a high inflation, high nominal interest rate, a volatile and overvalued exchange rate economy. And that was not really the preconditions that are necessary to have stability and predictability of policies, which will enable Sri Lanka, which would have enabled Sri Lanka to develop a competitive export sector. You can't compete in the global economy if you have unstable macroeconomic fundamentals, because there's a lot of unpredictability in policy, which comes from that instability, and that is not conducive for the kind of environment you need to go and compete in the global markets. So we were a twin deficit country, and the problems really were aggravated, I would say, in the last 10, 20 years by a couple of trends. The fiscal deficit was affected by the quite dramatic decline in revenue. Up to the mid-1990s, revenue was around 20% or a little bit more even of GDP. It has now come down to a little over 8%, but even before the pandemic and the tax cuts, revenue was down to 13% or so of GDP, and expenditure was about 20. So an inherently unsustainable situation. And that was really the root cause behind the first of the twin deficits, and that is the budget deficit. And at the same time, really our export performance also declined. It was never very good, but compared to the East and Southeast Asian countries, but it declined. Our exports of goods and services together as a percent of GDP, which was about 39% in 2000, declined to about 20%. So that is the primary underlying causal factor for the persistent current account deficit that we have. Our trade balance is in deficit most of the time, and it is too large for us to be able to finance it through remittances and other non-trade related flows. And so we end up with a current account deficit most years, almost every year, in fact. So that's why we are a twin deficit country, which is in the bucket of countries which are considered the most vulnerable. Now, that, if I may, so why did revenue decline like this? And here, I would like to share some thoughts with you, which I hope you will recognize as being acceptable. One is that during the conflict, we had to give a lot of concessions, tax concessions, to get projects over the hurdle rate of return. However, when the conflict ended, we did not change course. We continued to give these concessions. And one of the reasons why we had to do that was simply because we did not do the reforms that were necessary to create a good business climate. We didn't do the reforms to reduce the unit cost of electricity. We didn't do the reforms which would have generally reduced business costs. We didn't do the reforms which would have improved the business climate. As a result, we had to compensate for the lack of policy reform by giving these tax concessions, which meant that the revenue was given away because of a lack of reforms. And also there were vested interests which had these concessions, which were very good at protecting them. So all this combined to make sure that our revenue was basically inadequate. And because in budgetary terms, to avoid a debt problem, particularly a debt problem which was more likely to manifest itself when you have exposure to capital markets and rating agencies, you have to have a primary surplus in the budget. And as I said, 2017-18 were only 2 or 4 years in which we had a primary surplus since the mid-1950s. And now again, we are in deficit. So that is, in my view, the reason for the recurring and repeated deficits in the balance, in the budget and the government fiscal operations, which is at the root cause of many of our problems. Because of that, and the excess aggregate demand, the budget deficit pumps into the economy, and often this fiscal unsustainability was accompanied by fiscal forbearance in monetary policy, which amplified the problems. Because in order for the government to raise money cheaply, the central bank repressed financial markets, kept interest rates lower than they should have been, and that also added to the excess aggregate demand that was in the system. And that excess aggregate demand leads to inflation. Some of it leaks into imports, and you get a balance of payments problem. So that essentially has been a repeating cycle we've had over and over again. And the 16 IMF programs reflect those repeating cycles. And we haven't really been able to break out of it. So that's the problem. As I said, on the revenue side, I've given you some reasons. I would also like to share some reasons as to why I feel our export performance has been poor. As I said, overall, the business climate has not been conducive to assist businesses to compete in global markets. It has held them back. But on top of that, there has been an anti-export bias in our macroeconomic policy framework as well. Often the exchange rate was overvalued. Exporters were penalized at the expense of importers for much of the period over the last 30, 40 years, or even before that. In addition, protection has increased, and it has incentivized production for the small domestic market rather than incentivizing people to go out and compete in global markets, where the returns are higher, but the conditions are tougher. And so naturally people, when the incentive framework was encouraging them to produce for the domestic market, they tended to do that. They tended to prefer to do that, where competition was less. And also it was easier to get various concessions and operate as rentier capitalists, given the political system we had as well. So we have exchange rate, we have protection. And the other thing is that we have not been able to penetrate the most dynamic component of the international trading system, which is the global supply chains. The cross-border supply chains that have emerged in the last 20, 30 years, Sri Lanka has a negligible presence. And the reason for that is, in my view, in this modern production systems that we have, the distinction between imports and exports declines. You bring your stuff in, you do your little bit, and you send it out. Now, if you put a tariff in the middle of that, by way of a PAL or a cess or whatever it is, you become uncompetitive and you are excluded from supply chains. So we've had various tariffs that we put in place, which increased basically the costs and made us uncompetitive in terms of global supply chains. And of course, there were the other factors like the business climate and the unstable macroeconomic policies as well. But by having these tariffs in the middle of the chain, that was one of the main reasons why we were excluded from supply chains, and therefore we were excluded from the most dynamic component of the international trading system. And so, the prospects of diversifying our export basket, diversifying our markets, making our exports more complex, all that was made much, much more difficult. So that is really the background as to why we have been a twin deficit country. Let me move now to what I think are 5 immediate priorities that we need to address. Along with Shanta Devarajan and Shamini Kure, I'm part of a little group that's been trying to provide some advice. And these are the 5 areas we said that were immediate priorities. One, to address the crisis that had emerged. Initially, I gave you the background as to how we got there. I should also have said, I'm sorry, I missed out the very proximate causes of the crisis. I've given you the historical causes, but the proximate causes, as you all know very well, have been the tax cuts, the pandemic, the Ukraine problem, and also, in my view, the adherence for too long to what was termed this alternate strategy, which in my view had led to us going to the IMF very late. It also led to us getting our rating reduced, downgraded, and us losing access to capital markets. So all those things coming together were the kind of proximate reasons for the crisis. But what I talked to you earlier was the underlying problems which have been there for many years. And those problems were amplified many times over, really, by these proximate reasons, as I said, the tax cuts, the pandemic, the Ukraine crisis, and what I think were the detrimental effects of what one may call this alternate strategy, that was pursued. Okay, what are the 5 immediate priorities? One is a fund program. Clearly now we are on the way. We've got a new governor and a new ST and a new finance minister who seem committed to getting an IMF program. Of course, the finance minister has resigned, but while he was there, they were all committed to achieving an IMF program as quickly as possible. And negotiations, as you know, are currently underway. They're ongoing. And the governor has expressed that he's confident that a staff level agreement can be reached fairly quickly. And that seems reasonable because already, you know, quite a lot of the adjustment has taken place. There's been a big exchange rate adjustment, though perhaps the way that was done could have been better, but it has taken place and probably overshot. There's been the governor has and the monetary board have had a big interest rate adjustment. There may be a little bit more to do, but the big adjustment has already been made. And the fuel prices have been adjusted again, maybe a bit more to go, but a big adjustment has been made. So quite a lot has already been done. The big two buckets which need to be addressed, or 3 buckets really, one is the fiscal framework. What is the fiscal framework going to be that will get us on a path to debt sustainability? The second is what is the electricity prices, which probably will need to be adjusted significantly, and 1 or 2 things in terms of improving SOE performance beyond the electricity prices and the fuel prices. So, you know, the chances of getting staff level agreement within, say, 4 to 8 weeks is pretty good, in my view. And if we get staff level agreement and it is announced, because there is no basic agreement between the government and the IMF, it'll be a question of, you know, pace and sequencing, etc. That need to be negotiated. And so between 4 to 8 weeks, there's a reasonable chance of getting staff level agreement. And if we are very lucky, we might be able to do it even a bit quicker, but more likely to be in the 4 to 8 week window. So that's item 1. The staff level agreement, though, however, is only the first step, right? Because then the fund staff will have to make a proposal to the executive board of the IMF for an EFF facility, which would give it about $1 billion a year for over 3 years. Now, for that to happen, we have to show significant progress towards debt sustainability. So that is the second thing. So as I said, staff level agreement is probably doable, very doable, and hopefully doable in 4 to 8 weeks. But then to get the board paper done and approved, one needs to move on the debt sustainability. And here, the government has announced a standstill. And one should clarify something. I think the governor has already done it, in fact, but just to repeat what he has said, there was no choice. There are those who say that this was not done in the right sequence, that the creditors should have been consulted before it was announced. All that is very true. But when the governor took office, you know, within days, he found himself with a situation where reserves, actually on that day, the 13th of April, reserves were down to $5 million US. Gross official reserves were down to $5 million. I think the finance minister said it's less than 50 million in parliament the other day. But on that day, it was down to $5 million. And a few days later, we had a ISB coupon maturing, which had to be paid. So if we didn't do it on the 13th of April, we would have had a hard default because we wouldn't have been able to pay the coupon. So that is why it was done in the way it was done. And I think the creditors understand that. And it was a preemptive measure to have a standstill before full consultation, which is what is normally done. But everybody understood the circumstances under which that decision was made. And so hopefully that shouldn't deter the creditors from engaging with us constructively as we go forward. But the next thing that has to happen is the appointment of the financial and legal advisors. And my understanding is that the process, the procurement committees have done their work, they have made their recommendations, but there was cabinet approval required. And if the cabinet met on Monday, we probably would have had those appointments made. But now we have the issue of this outstanding matter, but it has to be, something has to be done and done quickly, because as I said, even the fund program cannot be finalized without movement on the debt restructuring, and the debt restructuring, really, it can only, the standstill has kicked it off, but it can really be taken forward only if the advisors, the financial and legal advisors, are appointed to be able to negotiate the debt restructuring on our behalf. The IMF will support in terms of providing information and a path to achieve that sustainability, etc., but they will not negotiate on our behalf. So we have to get these advisors appointed and done very, very quickly. What are possible risks as far as the debt restructuring is concerned? On bilateral debt, so essentially you already know that it is really bilateral debt and commercial debt that will be restructured. Multilateral debt cannot be restructured, because if one gets into arrears with the multilateral institutions, that is the IMF, World Bank and ADB, they will stop operations, all operations. So we can't have any arrears in relation to their operations. So it's really bilateral and commercial debt that has to be restructured. On the bilateral side, China has been very reluctant, I should say, to restructure debt. They're happy to refinance debt. In fact, I think they've already offered to provide a loan to refinance the debt that we owe them over the next 12 months. But the other creditors are watching exactly what China does. And because refinancing all the debt, it won't be sufficient for us. We have got to the point, we've left it so late, our reserves have declined to such a low level that we would have to have some kind of restructuring of the debt. There have to be some kind of haircut. So others do not, and so it's not enough, as I said, to refinance. You have to restructure and have a haircut. And other creditors won't take a haircut unless China is also willing to take a haircut. And the Chinese have said they are willing to refinance, and in other countries as well, but they've been far more reluctant to restructure. But there is a possible way out whereby if the Chinese debt can be stretched out and the interest rate can be brought down to a point where in NPV terms, the burden of Chinese debt is the same as the burden of restructured debt of other bilateral creditors, then that would be fine. In NPV terms, you have to have equal treatment. So that is one possible way out. So these are things that will have to be negotiated, but that is one issue that has to be addressed as to how China's debt would be treated, because everybody else is watching to see what treatment China would get before they are willing to undertake restructuring of their loans to us. On the commercial side, commercial debt side, hopefully things shouldn't be too difficult, because we don't have very complicated instruments. We don't have structured products, with derivatives, all these kind of things where there is a very complicated challenge in terms of unraveling things. We have a simple kind of plain vanilla ISBs and a couple of syndicated loans, which hopefully should make the negotiation process relatively straightforward. But of course, because now we have to impose a haircut, it'll be interesting to see how the creditors respond to that. I think they're reconciled to the fact that they will get a haircut. The question is how much of a haircut. SLDBs have been excluded, and the governor explained very well that the reason they've been excluded is that they will be settled in a manner which will not have a claim on our FX stock. That is what the other creditors will be bothered about. If they find that SLDBs are being excluded and yet they are being settled out of the stock of foreign exchange available to the country, then the other creditors would have a problem with them being excluded. But as they are not going to be a claim on the FX stock of the country, they should not have any problem with that. And the governor has also been very clear that domestic debt will not be included. And here I think the thing to remember is that the case that one has to make, because there are one or two people who are mumbling about domestic debt, is that the creditors, all creditors, external creditors, would not want a course of action that would undermine the chances of them getting their money back. If domestic debt is restructured and there is a banking crisis, then the prospects of the external creditors getting their money back would also be reduced. So that is the way I think one can present the case to them and say, look, don't make us do things which is going to be inimical to your own interests by creating a banking crisis in the country. So that's the debt restructuring part of it. And now that I'm on the banking sector, there are some concerns that there is stress in the banking system. The governor was very clear, I think, the other day, where he said that the central bank will stand behind the domestic banking system. It will do what is necessary to keep maintain the stability of the domestic banking system. There is an FX liquidity problem in one or two banks, and that would need to be addressed. But I do know that the central bank is consulting experts from both the IMF and the World Bank on financial system stability. So hopefully they will come up with a plan that will maintain both the FX stability on the FX side of the banking system, particularly the state banks, as well as the whole of the domestic banking operation. India is giving us considerable assistance. I think they've already given us about $1.9 billion worth of assistance through a swap, through a fuel line of credit and another line of credit for other essential imports. And they've deferred ACU payments during the course of this year, which in total could amount to another 400 times 6, about 2.5 billion. Plus, they are considering another fuel facility of 500 million and maybe another line of credit of $1 billion. So all in all, India could stump up about $6 billion by way of supporting Sri Lanka's sustenance in terms of ensuring that essential imports come through. But we need some cash. And for that, the president has written to the Prime Minister of Japan. And the Japanese, I think, will give some humanitarian assistance fairly quickly, but we'll have to wait and see whether they are willing to give us some further assistance, particularly to support the financial sector. China, as I said, they've said they're willing to refinance the debt. And they've also, one possibility is to see whether the restriction that has been placed on the PBOC swap, which makes it unusable, can be lifted. I think the government is negotiating to see whether that restriction can be lifted. But you see, and earlier, I think that China was put that restriction in because while they were willing to help us to dress up our gross official reserve number, they didn't want to increase the financial exposure to the country. And therefore, they made it very, very difficult for us to draw on that swap. But now that the country has gone to the IMF, debt restructuring is underway. Hopefully, they will feel more willing to undertake the increased exposure that would come by making the swap less restricted. And of course, that swaps are not included in the debt that will be restructured. And anyway, this measure will be taken after the 13th of April. So the fact that this swap was given before In fact, I think quite a long time before the 13th of April, maybe something that would be an issue. But as I said, at the moment, swaps are not included in the restructured debt. So that should be a source of reassurance for the Chinese. And hopefully they can remove that restriction, because that money is already in the central bank account. And just through a stroke of a pen, it can be made available. And that 1.5 billion would be tremendously useful because it is liquid cash that would be available to the central bank. Finally, as I said, there's been some stress in the banking system, but that I think the central bank is looking at very carefully. Social safety net. I think it's inevitable in the current circumstances that the social safety net would have to be expanded and made more efficient in terms of delivery. The World Bank has given 400 million, of which I think about half, roughly about a half, is for social transfers, which I think the government has already announced a program, and another 200 million for fertilizer, which will be very helpful. And I think there could be more money, maybe another 300 million that the World Bank will make available as part of this process of money that they are repurposing from projects they already have for Sri Lanka. So in all, I think about 700 million could come. So that's various sources of bridging finance. And of course, various parties are giving humanitarian assistance, relatively small amounts, which are coming in, but which are anyway extremely useful. Let me quickly run through some lessons I think that we need to learn out of this exercise. One is the need for a large dose of humility. You know, economic policy making has many, many uncontrollable variables. So you need to be very, to have a great deal of humility in dealing with the whole process of policymaking in the economic area. Secondly, policymaking needs to be evidence-based and data-driven. And one needs to put aside any preconceived biases, preferences one has. One needs to look at the data, look at the evidence, and take the best possible make the best possible choices in an objective way. Third lesson is we need to have clear frameworks for macroeconomic policy making. A flexible inflation targeting regime is what has been in place. You need to use the exchange rate in a flexible way as the first line of defense. You need some stronger fiscal rules to make sure that the budget works and to make sure that we have a primary surplus in the budget. We need to, from going forward, we will always have to have a primary surplus in the budget if we want to avoid this debt problem that we've got ourselves into. And we need to have a clear framework in terms of the independence of the central bank. It's crucial to remember that the central bank is not a development bank. The CBSL is all about stability, not about development. The country, I agree that the country needs a development bank. And in fact, the current governor, when he was senior deputy governor, undertook or oversaw a process which came up with a concept paper for a development bank. That is with the government. They should implement that and not use the central bank as a development bank. Because if you do use the central bank as a development bank, rather than a bank that has price and economic stability and financial system stability, that is stability as its primary objective, you can't get into the kind of trouble that we are in today. The central bank bill, which has got into parliament but was not able to be enacted, should be looked at again. In fact, the present governor was probably the father of that bill. He's the one who actually oversaw the whole process. So I hope he will see fit to introduce at least some elements of that bill, which is essential. If the central bank bill had been in place, if we had managed to get it enacted, it is quite possible that the tax cuts may not have taken place. I say that because the bill would have made it impossible or illegal for the central bank to participate in the primary auctions. And if the Treasury did not have the easy option of getting the central bank to buy Treasury bills and printing money, basically, buying Treasury bills, they may have thought twice about these tax cuts, which have been very damaging. And that's the whole point of having that regulation, so that you have checks and balances in the system. And you shouldn't have a process whereby the central bank makes it easy for the Treasury to have fiscal indiscipline and for the central bank to accommodate fiscal forbearance. We need to make sure that doesn't happen again. Another point is that we need an aggressive program of structural reforms. In the past, when we had these IMF programs, we would undertake the stabilization aspect of it, and quite often reasonably well, for a period of time until usually an election came. But the structural component of those programs were not implemented at all effectively, which meant that the stabilization programs are intended to compress demand, and therefore they slow down growth. So unless you have the structural reforms to boost the growth framework, you end up with lower growth. And this is why people say the IMF programs are a failure, all they give us is low growth. Well, one component of the IMF program is stabilization, and by definition, it slows the economy down. But then it's up to the government to undertake the structural reforms to get us onto a higher growth trajectory. And that is never done, really. Very seldom has any effort been made in that direction. So this time around, it's essential that upfront we do the structural reforms as well as the stabilization measures that are being taken. Because if we don't, it'll be actually even worse this time, because usually our IMF program is undertaken when the economy is overheating, when it is actually growing quite fast. This time we undertake out of necessity, we are undertaking an IMF program and introducing stabilization measures when growth is very muted. And so we can end up with stagflation. Inflation will come down, I think, with the stabilization measures, but we could have a deep recession, deeper than in the past, if we don't have the structural reforms to drive growth at the same time. Finally, I think social safety nets, we have to really focus on that, because when you have, not only because of the legacy of the last few years, the pandemic and Ukraine and all these other things that have hit us, but also because if you are going to go ahead with structural reforms, there will be winners and losers. And you need to have the social safety net has to be well designed, well targeted, and hopefully driven by technology. I hope the digital ID will come and help us to implement these programs in a way that minimizes leakages. Okay, finally, the country's potential has not gone away. We've had a bad time of it. The country's potential has not gone away. We just need to get better at utilizing that potential, taking advantage of that potential. So as far as that is concerned, I think the government needs to be more reliant on evidence-based policymaking and objective and not rigidly ideological policies and programs. And the private sector, for its part, needs to be less dependent on rent seeking that is based on political patronage, and it should become much more entrepreneurial and dynamic. So I think both the government and the private sector has lessons to learn from this experience. But as I said, the potential is there. Potential hasn't gone away, and we need to grasp it. Thank you.
Thank you, Dr. Indrajit, for your keynote remarks. And I think there were a lot of areas covered in his speech, the prognosis, what is the advisory committee advising at the moment, and some of the 5 key solutions that need to be really looked at. So we'll delve into this a bit more deeper. And I think there are Q&A questions also coming in on Zoom, as well as we do have a good reach on Facebook as well. So all of the followers on watching in on Facebook also, please send in your questions, and I'll pull it in as we get into the panel discussion. So let me first start off with a particular theme in terms of the implications on the economic outlook There are various variables we look at: the currency, interest rates, growth, and of course, what does debt restructuring really mean for the private sector and the different segments. I know we have a diverse audience from different segments of the economy, from exporters, importers, from the financial sector, and so on. So let's get into maybe the implications on the economic outlook, and maybe I'll ask Murtaza to maybe start off, and then we can get Amal to follow after that.
Thank you, Shiran. I'm acutely aware that the time is 4:25. There are another 3 speakers after me, and you will want to have a discussion. How much time do I have? 5 to 8 minutes?
Yeah, if you can take the initial one around 4 to 5 minutes.
Okay.
Great. Yeah.
So can you, there were lots of areas that Dr. Kumaraswamy covered. I just want to elaborate on a few things that he said to reinforce, because our audience may not fully understand. So I'm going to flip through some of these things quite quickly because there isn't time, but I'll try to tie it together. First of all, he talked about this concept of primary balance. I don't know how many of you are aware what a primary balance is, but simply think about it as the total revenue that the government gets minus all expenditure without interest. So for example, if you are not burdened with debt service, do you get enough revenue to pay your expenditure? And this particular graph at the bottom shows you as a percentage of GDP what we are doing. So for example, if you hypothetically assume that you default on your debt and then therefore nobody is going to service you, do you have revenue to meet all expenditure without interest? And you can see that this problem has got extremely accentuated towards the end of the last 2 years. So that's what he talks about, this primary balance, and that we have to get it into a surplus. We have got a surplus in 2018 and almost a balance in 2017. The previous time we did that was in the 1950s.
This is showing a slide, and I don't think we're seeing it at the moment.
Oh, you're not seeing it? Okay, no. Sorry. My apologies. I think, can you see now?
Yes, we can see it.
Okay, my apologies. So here is the primary balance, revenue minus primary expenditure. And this is what the graph looks like. And it has been accentuated in 2021 and 2020. Actually, the figure in 2020 was higher, but they shifted some of the expenditure to 2019. Next, this shows you as a percentage of GDP, the graph that I showed you as a line graph. And what you can see is that the expenditure has been coming down over a period of time as a proportion of GDP, but the revenue has been coming down further. And the next graph shows you the same 3 variables taking a base of 100 over a period of time. So you can see that GDP is growing, and then we have the tax cuts, the revenue as a proportion of that 100 comes down, and primary expenditure. This is all expenditure from a base of 100. So you can see that there's fundamentally something wrong, that the economy is growing, but revenue and even expenditure, this is primary recurrent expenditure, is not keeping up with the economy. So what is going on? So obviously one issue is that the areas of the economy that are growing are probably not getting taxed, or even other areas of the economy that were previously getting taxed are not getting taxed. So that is the fundamental reason for the significant fall in revenue. The next thing I wanted to quickly explain was about this domestic debt restructuring, and lots of people have a lot of concerns about it. This slide shows us the total debt. And if you look at our current debt at the end of 2021, it is something like 17.5 trillion. It probably went over 20 trillion after the big depreciation, out of which the domestic debt is about 11 trillion. Okay. Now, who owns this debt? Central bank has about 15%, the commercial banks 35%, and this is NSB, others. And then the EPF has another big chunk of 26%. So the issue here is that, like Dr. Kumaraswamy said, that if this debt is restructured, we will have a major financial system problem. Already with the ISBs being restructured, there's already an issue, but if this is being restructured, then there will be a significant issue. Now, if we do not want to do domestic debt restructuring, if I go back to this primary balance, we have to make this a surplus. which means that you do not have to borrow to finance your primary expenditure, that the revenue is sufficient to meet your primary expenditure. So then the challenge is only to roll over the debt. And in this particular case, when you see who owns the domestic debt, most of those are captive sources. So we don't have a capital account open. So this money can't go anywhere else. It is trapped in Sri Lanka. And because there are regulatory directives, like the banks have to put 20% of their liabilities in liquid assets, the insurance companies, the EPF has like almost 98% of it in government securities. It's a captive source. And that is why, as long as we can get our primary balance into a surplus, we do not have to restructure our domestic debt because it can be very easily rolled over. The next question is, who is going to bear the burden of all the adjustments? This is an important point because I don't have many minutes to speak here. I don't know how many people are familiar with these socioeconomic surveys. The top 10% decile controls 36% of the wealth, the income. The next decile controls 15%. Decile means if you break it into 10. And the bottom is only getting 2%. So you can see the skew. And at the bottom here, I've shown that the richest 20% get 51% of the income. The bottom 4.6% basically gets, bottom 20% only get 4.6%. So the question has to be that in the whatever restructuring that we do, we have to make sure that who bears the burden of all this restructuring. And that is why after we have come to such an enormous crisis in our country, that the type of reform that we do, the burden of adjustment has to be with those top 20% of households. This is very important, and that is why the issues of the political economy come in, that what has happened previously is all these tax concessions, even these fuel subsidies that are handed out, because fuel is sold even sometimes below market price. The World Bank has estimated that the top 30% of households get 70% of these subsidies. So one very important thing is, in this adjustment that we go forward, we have to make sure that the households that can afford this adjustment are the ones that have to bear the brunt of this. And the poorer households, as Dr. Kumaraswamy talked about cash transfers, etc., that if you're going to stop all price-based subsidies, which are very distortionary, and we're going to do cash transfers, that these cash transfers are properly targeted to the people who really need it. That itself is a science. And that we don't use too many intermediaries. At the moment, it is estimated that out of Samudri, about 20 to 25% leaks out in terms of administrative overhead, etc., that we allow prices to signal scarcity value in the economy, and you get the wealthier people to pay their fair price, and even we can put corrective taxes. But the bottom part basically has to be assisted, and cash transfers have to be done. And that is how our recovery will have to come. I will just finish off with some quick recommendations. One thing is that the quick things that we will have to do is, prior to 2020, about 180,000 people used to leave Sri Lanka for foreign employment. Then it came down significantly. With the kind of shock that the economy is going to take, in the short term, there are going to be a lot of job losses. So a big focus will have to be to find foreign employment opportunities for a lot of our population, because the demand destruction that will happen in our economy is going to lead to a lot of jobs that are being lost. The second problem that we have is, I am expecting about 1,000 companies to fail. They're going to go bankrupt. And some big companies also might go bankrupt because they're sitting on an enormous amount of debt. And these guys are addicted to debt. And when you start having prime interest rates at 20%, there's no way that they're going to survive. Now, we do not have a unified bankruptcy law in Sri Lanka. So there's only one person in SJMS or something who has some expertise in liquidation. And most of our companies act, which is geared towards resolution and liquidation, its a focus is on more liquidation. So we need a unified bankruptcy law that will allow all the creditors to sit around a table and resolve all this debt that's going to happen. So not only are we going to have a huge financial crisis because of this bad debt, but we may have a huge further economic loss because, these firms are going to go bust. So if they are going to be liquidated, there will be bigger losses, etc. So we need to urgently get a bankruptcy law going. And also one of the other things is that the central bank, Dr. Kumaraswamy talked about the central bank, it is riddled with conflicts and it has these agency functions. For example, the bank supervision, it has the function of the EPF, the debt office. All these things are massively conflicting. So to give you a graphic example, in terms of the international sovereign bonds, when the ratings were coming down, our bonds should have been credit risk weighted at 150%, right? What did our central bank had given a directive saying that you can credit risk weighting dollar bonds. These are not rupee. You can't print rupees and give it to them. We made the credit risk weighting 20%. But sometime about 1 year ago, a circular came from the central bank saying you can reduce basically the credit risk weighting to 10%, right? So what you have your capital adequacy ratios. So you were basically incentivizing the banks to allocate more and more into these international sovereign bonds with a very low capital charge. They also exempted the capital gains on international sovereign bonds, that if you bought it in the secondary market, etc. So, I mean, on one side, the central bank has to ensure financial stability, and on the other side, they're incentivizing them to take risk. And that is why you need an independent central bank with proper people, proper governance. And central bank, the governance, etc. previously, they are answerable. They are complicit in this massive disaster. So these are the few things that I wanted to say. Thank you.
Thank you, Mr. Amal, if I can maybe have you come
on. Thanks, Shiran. I'd agree with everything that Dr. Kumaraswamy and Murtaza said about what needs to be done. I'd like to touch on the other aspect of your question in terms of how the private sector, the different parties, actually can look in terms of navigating the crisis. So rather than thinking in terms of what the right policies should be and what we should look forward, how they can look in terms of navigating this crisis and what to look for in terms of exchange rates, interest rates, consumer demand conditions. Let me say something that's really important. The basic assumption and something we believe is likely, as Dr. Kumaraswamy said, but this is an absolutely critical assumption that at least by January next year, we have achieved a staff level agreement with the IMF and got our first disbursement through, or it's very likely the first disbursement is coming. I think Dr. Kumaraswamy gave a optimistic timeline of 4 to 8 weeks. I'd be cautious to base everything on that. It can be complicated given the politics of the moment, but by January, this needs to be done. I'd give it that 6 months. The period until then, and particularly the period where we feel the politics is complicating it, can be a period of continued volatility. But when it looks like the IMF deal is through, and this happens, markets tend to react before the actual event. You will likely see, so now we're having a big problem with the exchange rate, and there are the worries, the lack of confidence in the system is leading the exchange rate to overshoot. But if we can get this IMF, and that would be our assumption, I would think that compared to today, after going for depreciating further, we will likely have an exchange rate that is better than what we have now. And even on interest rates, we will probably see, with inflation expectations reducing by the end of the year, some improvement in the interest rate outlook. That's not to say this is the peak. Things can get worse, particularly the political instability. So that would be the good news in terms of what exporters and businesses can look for. It's not that we're expecting the rupee to be anything like 200. This is likely a number north of 300, but better than today. And even interest rates, we are not going back to the 10% levels anytime soon, but better than today. So, and this is something that we've seen. And the reason I say this is when you look at a history of all IMF programs since 1990, countries that have got through an IMF program and managed, I mean, to keep to it at least for 1 or 2 years, have got this stability in the financial variables. So this is the IMF program remains very critical. The bad news is demand conditions are going to be very bad. That is what austerity is. This is not a growth year, it's a negative year. I mean, this is obvious, it's common sense. So businesses relying on the domestic consumer are going to find it very hard. Right now, there is still, the austerity hasn't fully cut in. I think a lot of businesses are finding issues on the supply side in terms of managing consumer demand. I think a lot of business still there's relatively robust consumer demand. Despite all, it's just that the supply chain issues make it hard to meet that. I think that is a lot due to the fact that we have people stocking up. The worries, the volatility is actually causing the consumers that are able to stock up, and therefore you have a relatively robust demand, but you will probably very soon, and this is from what we've seen in the numbers, maybe it's already happening, see consumer demand falling off a cliff. And like Murtaza said, I think bankruptcies are inevitable, and then there's a follow-through effects. And in terms of where the consumer demand will likely get hit, hopefully the cash transfers or other targeting measures to protect the very poor can, I would hope, manage to keep their level of consumption, because it's so bad, at least at those, I think it's absolutely vital, and for all of us in terms of social stability, that is supported, that the poor are supported. But you know, that middle income sort of, you know, not the bottom 20, but beyond that is going to really feel the pinch, and that will also affect businesses a lot. Yeah, and it's going to be a hard year in that sense. So, and obviously what I said about the exchange rate, interest rates, each business can figure out how to position themselves around that.
Thanks, Amal. If you move to Dr. Roshan, I think just a bit on the outlook, I know Murtaza and Amal has covered so far, and also I think adding to what Dr. Injis mentioned about the IMF program, what particularly do you see as some of the key things that should be part of the structural reforms? We've seen the 2019 and the 16 program play out, not a lot was really achieved. Maybe you can comment on that.
Thank you, Shiran. So I want to sort of take our focus away from domestic issues and look globally, actually, because I think a lot of us are looking at what happened in India in 1991 during their reform process, and then the East Asian crisis and how those countries came out of that crisis. But I think what we have to understand is the global conditions are also very different in the East Asian and the domestic conditions. In the East Asian crisis, actually, those countries were growing at a very rapid rate, they had very high growth, fairly low inflation prior to the crisis. So they came in on the starting point was better. From the Indian point of view, the global economy really took off in the 1990s, so they were able to benefit from that. So Sri Lanka at this juncture is this crisis has hit us at a very bad time in terms of the global economy. The IMF in their latest review of the global economy in their World Economic Outlook, basically they have cut global growth by about 0.8%. And that is going to come due to various factors. One is, of course, the policy tightening, which we are seeing happening across central banks around the world because of demand pressures and inflation rising in those countries. So that is going to create tighter global financial conditions, and the availability of dollar liquidity to countries like us. So instead of capital inflows, they're going to see capital outflows. So how do we navigate that? How do we to how do we attract these inflows. Then, as Amal pointed out, the global supply chains, because particularly with lockdowns continuing in countries like China, there are issues with global supply chains which have raised input costs. So that again is going to affect domestic producers, both for the domestic market and for exports. Then, of course, the Ukraine war. It has had the impact in terms of commodity prices and fuel import prices, but also it's going to have a huge impact on the euro region, the slowdown in the euro region, which is one of our main trading partners. So there's going to be an impact on exports. So how do we navigate that? So that's from the growth side, but also from the inflation side. We are impacted both by global and domestic conditions. And I think we talked about some of these, the rise in commodity prices, according to the world food prices. So apart from, we're seeing it translated into our domestic prices. So, but the world food prices have increased by 36% year on year. And partly this is due to the opening up of economies, but also due to the Ukraine crisis. So there's been worsening, as a result, worsening terms of trade, which is going to see a widening of our current account balance. So how do we deal with that? We're already having issues trying to finance the current account balance, but with the worsening terms of trade, how do we navigate that? And also the high fuel and food prices feeding into inflation. Apart from, of course, the domestic issues, which was the excess demand, the result of increase in money supply and tax cuts. And I think that is partly the reason why we're not seeing a slowdown in domestic demand, because there is still this money in circulation, and the taxes are still, relatively low. Plus, of course, this fertilizer issue is going to play out very soon. So how do we navigate that? We need to aggressively address inflation, I think. That should be paramount. Because we've seen inflation in April is 30%, it's likely to go higher. This is the last time we saw this is in 2008. That was kind of in the height of the war. The worrying thing is co-inflation, which basically measures underlying demand pressures, has increased by 22%. That is probably the highest we've ever seen. So price stability is vital for economic stability and sustainable economic growth. So we cannot drop the ball on inflation. So we really need to go on an all-out offensive to reduce this demand. We have raised policy interest and interest rates have risen, but you still see the policy rates are lagging market rates. And we still see real interest rates are negative. So that is one area that we need to focus on. But it's not only from the monetary policy side. We also need to have the fiscal policy measures need to be in place, and we're not seeing that as yet, right? So the fiscal deficit, I think Murtaza talked about taxes and how taxes have been affected. We really need to bring those in quickly, raising taxes, adjusting prices, particularly of the SOE, so energy prices, because that's a huge drain on the economy and on the fiscal. So those are things that need to be done. But of course, we know that all these things will have a negative impact on growth. So we need to undertake economic reforms to boost productivity. And I think I can talk more about this maybe in the next, later in the discussion. But I think we really need to be mindful of inflation. That needs to be, I know there are a lot of arguments of why are we raising rates? It's going to affect domestic policy, but I think unless we get inflation under check, it's going to have an impact on everything else, on the macroeconomic stability. So I think we really need to keep our focus on that, get that in check, address growth in different way, and maybe I can talk about this later in the discussion. But also, of course, some of these policies are going to be painful, because we're talking about raising, adjusting energy prices. The exchange rate is obviously going to feed into prices. So government, as I think all the speakers have talked about, we need to have well-targeted support for vulnerable populations in the context of these high energy and food prices. I'll stop there and maybe take some of these points up later.
Thanks, Dr. Roshan. I think a good point of not forgetting of the global dynamics, which are constantly changing as well, and how that's also been impacting the economy and where we are at. Daniel, if I get you online, I think you were part of the advisory team with the Ministry of Finance when the IMF program was last on. What would you be kind of advising right now, given some of the structural reforms that are being discussed need to be included as part of this, and any particular implications for the private sector, given the outlook?
Yeah, thanks, Shiran. Can you hear me properly?
Yes, all good. Yeah.
Okay, good. So before going into the IMF program specifically, I think I'd like to put it into the broader context of the Sri Lankan state's failure to address some of the core questions that Sri Lanka faces over the last couple of decades. So the IMF program is one other example of the internationalization of what is fundamentally domestic policy. And we've seen this happen before with respect to the national question, which was internationalized in the form of the UNHRC, and then also our ability to conduct foreign policy on the basis of our own interests has also been hampered by our dependence initially on one country and now perhaps on 2 or 3 countries. So we have a state at the moment which is unable to effectively manage its core areas of competence by itself, and which is why we are now in the situation where we have internationalized many of these key areas of policy making. In that context, I'm going to focus today on the economic angle, which is the IMF. This is not, of course, new. As everyone here probably knows, we've been through 16 different IMF programs, and there are 2 main types of program. There's the short-term standby agreements, which are primarily focused on stabilization, and then there are the longer extended programs, which are focused both on stabilization and on restructuring the economy for longer term growth. And these generally last about 3 years. So in this case, we are probably talking about an extended facility, and that's the context in which negotiations are probably taking place with the IMF. So in the question which I'm really hoping to answer here is how should this program be set up? Generally, the program is set up in the process where certain actions are undertaken, and on the basis of those actions, funds are dispersed. And usually it's about 5 or 6 different tranches over a period of 3 years. And I think there's 3 questions that arise at this point, or 3 areas I'd like to discuss. The first is something that both Indrajit and Murtaza referred to, which was the primary balance. And that's fundamentally the question of how do you play around with revenue and expenditure to get yourself into a primary balance. The second is with respect to unlocking growth. So as you stabilize the economy, in order to improve your debt to GDP ratio and make your debt sustainable, and of course to achieve your development goals, you need to fundamentally unlock growth. And then the third is, what are the political foundations for that growth? And I think that's something I'd like to touch on as well. So let's start with the first one, revenue and expenditure. So at a very high level, many people in the audience undoubtedly know, Sri Lanka is a low tax, low spend economy. Tax to GDP ratio, as the previous panelists have mentioned, is one of the worst in the world and has been declining precipitously. This is something that needs to be arrested immediately. And the way in which that's done is going to be important. We need to ensure that those who are best able to be taxed, in other words, the rich, are those who bear a greater share of the burden than the poor. And in other words, we need to make our tax code more progressive. So that means relying less on indirect taxes and more on direct taxes. This process had already begun in 2017 with the Inland Revenue Act. And then I think basically we need to start the process again with the current reversals of the 2019 tax cuts. And this includes a significant component of tax administration as well, because it's not just a question of changing the tax rates. It's also improving the state's ability to be able to collect those taxes. So that's on the revenue side, I think, is the key sort of conceptual framework for thinking about that. I'd just like to add one more point on revenue as well, which is removing discretion in sources of state revenue. So, for example, indexation of excise taxes, ensuring that high revenue non-tax revenue sources are allocated on the basis of efficiency. So, for example, telecom spectrum and so on are auctioned rather than given on the basis of any form of discretion. And more generally, I'll touch upon this in the third section, is moving taxation powers away from ministerial discretion towards parliamentary primary legislation, because so much of our tax code can be changed at the stroke of the finance minister's pen. And this has led to not only instability, but also in some cases suboptimal revenue mobilization. Moving on to expenditure, I think there's broad consensus now that Sri Lanka, the problem is not that we spend too much, it's how we spend it, where we spend it. We do not get the return on our spending. So there, I think there are a couple of points. The first is, of course, the public sector. The public sector has grown dramatically in the last 20 years compared to the previous couple of decades before that. It is unclear what the rationale or the efficiency gains that have arisen from that growth in the public sector. If you look at the data, it is primarily in the lower public sector, in other words, development officers and things like that. So there's every reason to think that it is driven by political economy considerations rather than return on investment considerations. So that's something that will have to be looked at, because that also affects the ability of the economy to be productive, because these workers are obviously employed unproductively. This is also the case, I think, with the military, where post-war Sri Lanka is continuing to spend more than it did during the war and has not reassessed its military requirements in light of the latest threat conditions. So that's one on expenditure. The second main area, I think, will be social transfers. Currently, a lot of government expenditure on social transfers occurs indirectly through subsidies for energy and other fertilizer and other goods and services. Previous panelists have discussed the inefficiency that arises, but also the targeting problems are something I'd like to highlight. For example, if you look at Samurdhi, the bottom of all the Samurdhi money that's spent, only 40% reaches the bottom 20% of society. So and 10% actually goes to the richest 20%. So there's huge leakage problems in the way things are currently conducted. And then fuel subsidies are also highly regressive, because they tend to favor the middle class who are able to drive rather than people who travel by public transport. So having a bonfire of existing subsidies and replacing them with a scheme of efficiently targeted cash transfers, I think will also be critical on the expenditure side of things. Moving on to growth. So that's on the primary surplus. Moving on to growth, I think the priority at this juncture is SOEs, because it cuts down expenditure while also bringing in some immediate revenue, and thirdly, in the long run, bringing growth. So it kind of hits all these targets in one go. And I think here we need to really be bold. We just can't have business as usual. It can't just be another IMF program. We need to be ambitious and say, we want to set Sri Lanka on a trajectory that is different from what has existed in the past, that is a break from the past. And that means we really have to be bold. And I think the principle here should be, then we need to have a national conversation on this, but I would argue that the principle should be, in any competitive industry, the government should divest all its holdings. So that includes the JI and Unity container terminals, potentially the airports, the state banks, SLT, the insurance corporation, a comprehensive divestment of all non-natural monopoly state-owned enterprises. Then, secondly, with respect to growth, is there are many areas where there is a lack of competition in the economy. So I think with the expiry of the Fair Trading Commission Act, we have not had any effective competition legislation in Sri Lanka. So bringing in an effective framework for competition is also going to be important to help boost productivity. And related to that is tariffs, because the huge amount of tariff protection has allocated our resources into inefficient sectors rather than in globally competitive efficient sectors. So a sustained framework of tariff liberalization and simplification is critical. What I would argue is we need to compete with others in the region. So what we should do is, over a period of 5 years, through the device of primary legislation, benchmark our tariffs to the average of Singapore, ASEAN as a whole, and Dubai. And that can provide a clear tariff anchor and stability for our industries as they think about the external sector, combined with FTAs. So that's broadly on the growth side. And the final point I'd like to touch on is economic governance. Now, as was alluded to by earlier panelists, for example, the Monetary Law Act, should it have existed, could have prevented the tax cuts, could have prevented the profligate fiscal policy that was conducted over the last 2 years that bears significant responsibility for the immediate cause of this crisis, at least. And they're establishing a robust framework for an independent central bank, a robust system of fiscal rules and checks and balances is vital. However, this cannot take place in the absence of constitutional reform. You cannot have, as an independent central bank, you cannot have fiscal rules that are enforced. You cannot have borrowing limits, which are an example of fiscal rules, without having a major constitutional change. And this is something that is necessary for the fundamental problems to be solved. Let me provide you with an example. Under the Fiscal Management Responsibility Act, it is likely that some of the bonds issued in May 2020 were not strictly legal because the government was in excess of the borrowing limit. This was brought to the attention of the Supreme Court via a petition, but it was not taken up. However, had there been a robust and independent system in place, had the Constitution ensured that both institutions and institutions that guarded those institutions and the legal framework were in place, then I don't think this would have happened. And that's what we really need as the anchor for this entire process, is an effective system of checks and balances and independent institutions and the rule of law established through the Constitution. Thank you.
Thanks, Daniel. I know we're past the 5 o'clock time, but I think conversation is very interesting and there's a lot to cover as well. So we'll probably go on for the next 20 to 25 minutes if that's fine by all. So just digressing into the questions coming in from the chat box, I think there's various themes coming out of it. So let's take, I think, the debt restructuring implications first. Maybe if I can get Murtaza to answer the question on what if foreign creditors refuse, similar to Argentina, to take a haircut without taking a domestic one? What are the implications? Also, there is no collective action clauses for the July 2020 maturity. Any implications from that? Maybe something for maybe Amal to talk about. I think since you've been looking at some of the countries that have gone through IMF processes, how has the bounce back been? Is there any timelines that we can think through? Because Sri Lanka is not the only country that has recently gone through debt restructuring. And will there be chances of haircut for individual domestic savings is also another question. So maybe Murtaza, you can start off and then Amal can add in, and if any other panelists want to. Just keep the remarks very short due to time.
Okay, so the question was about the external debt. Let's look at it. Is about $36 to $37 billion. Out of that, there's about $10 billion which is owed to the multilaterals. That is off the table, right? So what are you left with? 36 minus the 10, you're left with about 26. Out of the 26, the euro bonds, or what we call international sovereign bonds, are 12.5 billion. And then you have bilateral creditors, 5 to 6 billion. And there is another part which are called commercial creditors, which are loans, mainly from China Exim Bank, China Development Bank, and a few other banks. I think the question was about the Eurobonds or ISBs. That's 12.5 billion. I believe about 17 to 18% of that is owned by a Sri Lankan banks. There's about 1.8 billion or something owed by them or domestic residents. So all of them, to my understanding, have collective action clauses. Some have what I call classic one-legged and some have two-legged. These collective action clauses are there to prevent what is called minority holdouts. That means a few people who don't agree to go by what the majority is. Now, if the creditors don't agree, then the whole process gets dragged on and dragged on. And that is why the collective action clauses are there to ensure that a few people cannot hold out against the majority. Because the longer the creditors hold out, the chances of them getting paid are less. So there is an incentive also to settle. And the longer the crisis gets prolonged, the ability of Sri Lanka to pay also becomes problematic. So far, going by the experience of some other countries, and provided that we select good financial and legal advisors, I think the chances of us making progress is also good. The chances of making progress is also dependent on what type of government that we are going to get, whether the creditors think that we are committed to economic reform, because our ability to pay is going to depend on us coming out of this crisis and growing the economy, and also what is called inter-creditor equity, that all have been treated similarly. So that was a little bit long-winded. That was the answer to the debt restructuring. I think Amal may want to add something.
Thanks. Shiran, I think the question you wanted me to answer is about other IMF, what examples we can take and whether we can get out of this fairly quickly. So if you broadly look at it, if you look at the causes of the crisis, that it's a public debt, foreign borrowing by the government, you typically find the Latin American countries being the most similar ones, rather than the Asian financial crisis, which was more private sector debt related. Dominican Republic, and also, for example, Seychelles. So there is so many. I mean, that's another useful point to make. This is one of, I don't know whether it's good news, but to avoid too much pessimism, some people think that it's maybe less than 10 countries that have gone through a sovereign debt crisis. The reality is, in 1950, close to a default. So, and economic more common than you think. But though I said the Latin American countries are more similar from an economic structure point of view, I think in some ways the politics, I'm tending to feel, and I've always worried about this, what kind of crisis we end up with. It feels to me right now, with the politics, we are more similar to what Indonesia went through in 1997 and 98, where it wasn't a very clear resolution of everything, which did delay things and led to the full recovery. If you take it from a GDP per capita point of view, for example, to be a good 8-9 years, but there was a recovery, there was stabilization. By 1999, there was stabilization in Indonesia, currency recovery, improvement in interest rates, but the hit to confidence was big. So it was a relatively slow recovery to get back to where they were. So that's what I would say. So I think I'm confident of that we'll get to stabilization sometime next year, an improvement in terms of financial variables, but in terms of living standards, I think it's going to be which is quite an important thing, living standards for people. It's going to be a long time, and that's why I say you can't be expecting the poor, the bottom 20% or even the 40% to be waiting 8 years to get back to, in fact, they should be protected as much as possible where they don't lose out. But for the rest, it will be quite a long time to recover. And one important thing to say, and this is a hard thing to sugarcoat. Now, when we think of typically the top 20%, people think of it as you know, you may be thinking of the audience of this likely. But when you think about it in terms of what the top, particularly below the top 10%, it's not what you typically think as rich. You think of them typically in a mindset way as lower middle class. They may often not even have a personal vehicle at home. So Sri Lanka, the top bottom 20% is extremely poor, you know, and that middle consumer, you know, who maybe, you know, what they have is a motorbike, for example, you know, that is the middle. It's not the poor. And they are going to get hit very badly. And there are, I think there are other questions. I think social stability, the perception of inequality against the rich, those are other issues to think about. And in terms of how people behave, conspicuous consumption, there's a lot of issues here that have to be thought about.
Shiran, I wanted to add something more. He gave the comparison. You see, Thailand had a king who was revered. He had moral leadership. So he was able to bring all the factions together and say, look, you know, you got to compromise. Indonesia didn't have a person like that because Suharto was ejected out. He was considered too close and they went after the Chinese. My fear in Sri Lanka with the political dynamics is we don't have a strong moral leader to bring the population together, all the ethnicities, communities. So to us to get an economic solution, we need social stability and a political stability. And that's lacking, and that's going to be a major challenge.
Thanks, Mrs. Just a couple of other questions. There was a question earlier on in terms of the situation for private sector dollar loans that have been soft guarantees by the central bank. And there was a question, I don't know if you answered it, on the haircut of domestic savings. I think that's a concern arising from domestic debt restructuring. I don't know if you want to take those two.
Did you want me to answer that?
Yeah, if you could.
So what was the question? I didn't hear you clearly.
The impact of the private sector USD loans that have swap guarantees with the central bank.
Okay, so you have to think about it like this. The bank has a rupee book and a dollar book, right? So as I explained previously, that the governor also has said very clearly that they are not going to restructure the domestic debt. And as I said, that if you run a primary balance surplus, the need to restructure is not there. And that will require two main things. One is that you have to change the tax policy, but most importantly, you have to get this economy to grow, because the tax buoyancy is necessary to get the tax to GDP up. Now, with regard to stability, former Governor Kumaraswamy also said that this governor has said that the central bank is a bank of last resort and they will do whatever necessary to stabilize the system. So I think that to be excessively concerned about a systemic stability issue on the rupee book is very low. But in terms of the dollar book, it's common knowledge that there is a huge shortage. And the inability to roll over the ISBs and even the SLDBs, there is a big mismatch between the assets and liabilities. So what is called the net open position of the banks, they are given a certain corridor to which they operate. This is probably exploded. So what's going to happen is that there is definitely going to be dollar liquidity issues on your liability side. So it is common knowledge that, you know, some of the state banks, etc., that if you go to withdraw dollar deposits, large ones, they will say that we cannot give it to you immediately, that we will have to put a payment plan over a period of time. And in order for this dollar liquidity to get sorted out, that is why they need a bridging loan. And if they get a bridging, if the central bank gets a large bridging loan in the form of a swap, then they can swap those dollars with some of the state banks who have defaulted on their swap until this whole system gets unclogged, which will probably take 6 to 12 months.
Thanks, Murtaza. Switching to the theme on inflation, a couple of questions that have come in, Dr. Roshan. I think there's one to you specifically in terms of a lot of it is driven by supply side factors. What can be done to address this? Would rate hikes just kind of exaggerate the situation and slow down demand? There's also, I think, a question before that in terms of the impact of money printing and the kind of the circular effect on the economic cycle. So maybe Dr. Roshan and Daniel, if you want to add on this and previously and after that. Thanks.
Yeah, so that's what actually in my previous comments, I mentioned that the macro stabilization program is going to be very painful because it's going to have a huge cost on the economy and in terms of slowing down growth. But that's why we need to also in parallel have this structural adjustment program or structural reforms. And I think Daniel alluded to some of these things where we have to unleash the growth potential. Because fundamentally, what is the objective of our economic policy? It's basically to raise living standards or improve well-being of all citizens, right? And what we have seen is that growth in Sri Lanka has been very volatile. It's been, these huge spurts of high growth, but they have been short-lived because they have been, growth has basically been due to very short-term measures. So either we have these cycles of election spending, where just before an election we have this huge growth spurt, but this has never been sustained in the medium term, and that also led to this unsustainable fiscal policy and macro instability, and as a result, all these IMF programs. That was one. The other one has been also the post-civil war sort of debt-driven infrastructure spending led growth, and that again we know is unsustainable. Again, that is something that has led us to these unsustainable debt levels. So I think we really need to focus on reforms. IMF programs that talk about some reforms. They talk about SOE reforms, fiscal reforms, and exchange rate reforms, things like that. But I think as a country, we also need to talk about how are we going to unleash growth. How do we, our growth has been very much concentrated in non-tradable sectors because of the incentive structures in the economy. It has been very much an expansion, particularly recently, of expansion of the public sector, involvement in many areas of the economy, and I think Daniel talked about that. It has absorbed a lot of national savings, which have not been productively utilized. Basically, it has gone into a black hole. So those areas need to be changed. Given that we are also a country of 22 million, a population of 22 million, we also need to be outward oriented. We cannot focus on this kind of trade protection, import substitution kind of policies, which we've tried in the 60s and 70s and have been utter failure. And even other countries who have tried that it has been utter failure. So all these kind of reforms have to be put in. We need to have reforms that will improve. It has to be productivity-led growth and job creation. I mean, one of the things is job creation. Why is it that the public sector has this huge number of jobs? Because one reason is maybe the formal sector is not creating those jobs for various reasons. So we need to, and I think Murtaza talked about it, in this current context, we are going to lose jobs. But how do we create jobs? I think that is something that we need to look at. Maybe once the stabilization is, we've had this macro stabilization, we need to know how are we going to create these jobs. The other thing is the agriculture sector. I mean, these are things that an IMF program doesn't necessarily talk about. So I think these are some things that we have to go beyond IMF plus, and talking about how do we move the labor out of these unproductive sectors into more productive sectors. And that will require investments in education, health, skills development. So those are things that we need to talk about, and we need to see how do we move labor from the informal sector, because at the moment we have something like 58% of our labor force in the informal sector. And actually it's about 67% if you talk about employees in the formal sector who are in informal employment. So we need to address what are the root causes for this formality in the economy, in terms of labor laws, in terms of doing business, the barriers to doing business. And these are maybe trade-offs you need to make, because at the end of the day, workers in the informal sector don't necessarily have the social safety nets and the protection that is afforded to employees in the formal sector. They don't get their remuneration or their wages are much lower than employees in the formal sector. So I think all these things have to be addressed in terms of in parallel with the stabilization program. We need to be thinking about how do we unleash the growth potential in the country, because this is the failure of many countries that have gone through IMF programs. Because you have these huge austerity measures, but in parallel you have to make sure that you have also this growth, unleash the growth potential, and that is through reforms, both trade and other reforms that I've just mentioned.
Thanks, Dr. Roshan. I think while you were speaking, there were some comments in terms of maybe labor market reforms that could be potentially on the agenda, in terms of downscaling the public sector, and a few coming from the online as well, in terms of would the IMF consider the number of public sector employees, free education, free health service, in the whole reform agenda program. So maybe yourself and maybe Daniel can comment on that. Amal, maybe you want to add something in, and then I'll go straight to Daniel.
Shiran, I'd like to add something more to what Dr. Roshan said. So the question is, why does government not go ahead with these productivity reforms? And I've been thinking about that, preparing for this. And one thing I've realized is businesses, and since this is a business audience, tends to look at everything from their own individual industry's point of view. And that is easy enough to understand, and it's not just on a profit motive basis. You typically, most entrepreneurs believe they're adding some value to society by serving their customers, by giving employment, and they tend to think of their industries as being important contributors to the economy. As a result, you tend to lobby, and I'm trying to put it in a perspective because I know entrepreneurs, it's not just about profit. You believe you're doing a valuable service by running a business, but you only think about it in terms of your industry. So what you lobby the government for is tax concessions, subsidies, protection for your industry only. And I think a role the private sector has to say is stop thinking about it from your own perspective and your industry. It is very legitimate. I can understand thinking through your own stakeholders, but think about it. No, it's not just let's focus on those productivity reforms. Let's focus on those labor reforms. Let's focus on ease of doing business that benefits business as a whole, as opposed to specific industries, because otherwise, and particularly through this austerity process, I am a bit worried because you're going to find certain industries that are going to get badly hit, highly leveraged businesses. And that is part of the adjustment process, but they will be looking for bailouts, subsidies that are not going to be very easy to do, but through the political business nexus, they might get it. And that's very important. The private sector tries to think not individually and not even from individual industries, but from these productivity reforms, because otherwise, how does it happen? And that is the role the private sector can take.
Thanks, Amal. Daniel, you want to comment?
Yeah, so 3 quick points. One on initiative, the second on inflation, and the third more broadly on ideology. So Amal, I think your point is really well taken. And I think the point Murtaza alluded to on a bankruptcy act could be an example of something where the private sector takes the lead and puts a draft out. I've rarely seen the private sector put out draft legislation or even draft regulation to generate public debate. So that's, I think, one opportunity. On inflation, I think the 3 drivers which I see. The first is the appreciation of the US dollar as interest rates keep rising, as in the Fed's interest rates could result, of course, in the rupee depreciating and then inflationary effects down the line. The second, of course, is global supply chain issues, partly through the Ukraine war, partly more generally trade war associated stuff, and then domestic supply chain issues as well. So all of these are likely to persist over the coming months and are going to generate some inflationary pressure. Then finally, on the point of reforms and ideology specifically, let's take the case of paddy. So paddy is something where we have invested a huge amount of money over the years. We've invested in irrigation systems to subsidize the development of paddy agriculture. We have also passed laws that prevent land from being used optimally. In other words, it has to be used for paddy, it can't be used for anything else. These are not driven on the basis of any cost-benefit analysis. These are fundamentally ideological economic policies. And I think we can look at it. The argument is made about food security and so on and so forth. But I don't think that argument holds water, because if you compare that to the money that is spent on fisheries, for example, which is both food security and an export industry, you have almost nothing spent. On the entire eastern coast, there is one fisheries harbor. So I really don't think it's a tenable argument. And what I'm trying to illustrate here is that we can't be business as usual. We can't just accept the status quo of muddled thinking, of ideologically driven thinking anymore. And I think this is something where even the chamber could take the lead. I know that in the past, for example, on MCC, the chamber has sometimes taken positions that aren't necessarily, in my view at least, based necessarily on purely what generates the highest return on investment. But I think it's time to change that, and we have an opportunity to reset our thinking right now.
Thanks, Daniel. Couple of questions coming in terms of tax policy, required changes for FDI, and I think also in terms of targeting certain sectors as well. I think draws down to the same thing of selecting or picking winners and losers in terms of the recovery. I don't know if there's any broad comments that the panelists would want to add on this.
So let me say something, Shiran, and also before we end, I want to make another comment on something slightly different, but with regard to this, the overall evidence globally is that tax concessions, now Daniel talked about expenditure. No? One of the largest sources of expenditure after interest and salaries is what is called tax expenditure. The IMF told us 5 years ago in the last program, quantify that and put how much are you losing by giving all these tax concessions. They kind of had a feeble attempt for 1 year and they stopped doing it. So one of the things that has to come out of this so-called revolution is that we have to pressure the treasury to quantify how much of tax expenditure is going on in the economy. And then we have to ask the question, is this money well spent? So the basic economic theory is that, you know, a business will do some economic activity or invest, provided its return is in excess of the cost of capital. That's the pure corporate finance kind of thinking. Now, there are some cases where the private returns are lower than the social returns. So, for example, there's a critical piece of infrastructure that will create a significant multiplier effect. But that piece of infrastructure itself cannot capture the total returns. So, for example, if you build a road, you can't recover the cost of building the road by having a road usage fee, for example. But that road is essential for so many other things to happen by the people who travel on that road. And what happens elsewhere is that when you build a highway, etc., you will also acquire the real estate around the exits, and then that value goes up and you recover part of the cost. Now in Sri Lanka, the way some of these tax incentives have been given, they are not based on any scientific method. And if you look at the strategic development acts, etc., I am willing to come out and say that there is a significant question whether there was large-scale corruption also involved on the basis on which these things were awarded. And we have to re-examine all these entities that are benefiting from these huge tax incentives and ask ourselves the question that is this justifiable? That if we have to do a complete restructuring of the economy now that we have defaulted on our creditors, should we also re-examine these agreements and ask that whether they are justifiable to the society, that these companies continue to enjoy all these benefits? Having said all of that, Shiran, the evidence all over the world is that tax incentives don't matter, that it is number 5 or 6 in attracting investment. And now that the base erosion and profit shifting framework, which is called BEPS 2 framework, that has come, which all OECD countries have signed, Sri Lanka didn't sign, but that is only eligible for our corporates. But any OECD corporate or any signatory to that, which is coming from a company with revenues in excess of 750 million euro, if they are not taxed in a particular country, they will be taxed in their home country for at least 15%. Right? This was a big agreement that was signed about 9 months ago. And I think the Americans really pushed this to happen. So tax incentives should be significantly off the table, and it doesn't matter unless there is very extreme cases where the social returns are in excess of the private returns that are below the cost of capital. The next thing is the most important thing for a business to invest is they have to be able to make money, right? And I think some of the other speakers alluded about doing business, etc. Our system is designed to frustrate people. I know I am doing certain projects, etc., in energy, etc. You need 16 approvals. It is the navigating government, basically. It's not one government, it's multiple government. And between government agencies also, there is complete coordination failure. And some regulations counteract other regulations. So we have to improve all those things. And there is no point saying that we will give you tax incentives because we are inefficient, because tax incentives come at a huge cost. So it is better for us to get our act together and basically make it much easier, and the issues of the political economy coming, so that business people who come and invest in Sri Lanka, the chances of them making a profit are easier and more predictable, right? And tax only matters when you make money. But the fundamental problem is to make money. I would like to make one more comment very quickly, because I'm speaking a lot also. You know, in this reform that Sri Lanka has to go through, we need a fundamental change in the electoral system that we have, right? Now, you know what's going on in parliament, etc. That our current electoral system is based on this Manape system, preferential voting system. Our elected representatives, they have to fight it out on a district basis. So if you're Colombo district, you have to compete within your existing party, and you have to compete in an environment where there is about like 2 million voters. In Colombo, there are 2 million voters, Gampaha, 2 million voters. So the amount of money that you need to become a politician is very high, 200, 300, maybe with the inflation now 400. So, you know, that itself, the fact that you need a lot of money to become an MP, it leads to perverse outcomes. And therefore, if we do this 21st Amendment, and you can listen to a conversation that I had with Asanka Valikala, where he explains clearly all the changes that will, the fundamental nature of Parliament will change. So Parliament has a huge fiscal oversight responsibility and economic governance. Now we are talking about coming out of this crisis, right? So you will need to have a really cracker Parliament that will be able to enact all sorts of legislation. So the type of politicians that we will require will have to be completely different to the type of people we now have. And in order to attract, you know, more talented and capable people, the amount of money to win should come down. And that is why we need electoral reform. One system that has been suggested is something analogous to the German system, which is parallel voting. 2/3 of the seats come first past the post. So there is about 16 million voters. Each electorate will have about 110,000 people in it. And 1/3 of the seat goes to proportional representation. Thanks for that, Shiran. So I wanted to stress on the importance that the electoral reform also be part of all the other reform that will happen in our country.
Thanks, Murtaza. I think we're close to end of the webinar time, but maybe let me ask the panelists if there's any final comments from them. Also, the question of maybe they want to answer the question of what the private sector's role could really be in this economic stabilization / revival, given the different timelines that are involved as well. So maybe Amal, I'll start with you, and then we'll go to Daniel and then Dr. Roshan to close. Amal, you're on mute.
In terms of the private sector's role, I think stop thinking individually. I mean, what can the private sector do? What can I do? The governor gave an example of this. He talked about how exporters recently, yesterday, this very good press conference he gave, when they are converting the export proceeds, rather than letting the bank just take it and then allocate as necessary, he said there's a practice, and this is also understood also in terms of business relationships and all that, where they will tell, look, please allocate it to this importer, right? So there is this conversion requirement, and please allocate to this importer. And that feeds into the problem of why we are wondering why essentials are not necessarily being funded and non-essentials are out there. It also feeds into what he said. I mean, there's a role as an individual consumer and all that. Right now, in this moment, what we choose, because the market mechanism, yes, I mean, I joke about this. I enjoy my imported cheese. Now, when I go out there and buy, and we as individuals keep doing that, you are actually ending up through varied mechanisms. A market mechanism makes sure that is supplied as opposed to essentials. So I think about this a lot, that what happens at an individual level replicated on a mass scale causes some of the problems. So I think businesses, I'm worried a lot about social stability and inequality. Businesses may need to take a decision, those that are profitable, where this year there's a massive inflation. Your workers, your stakeholders, you may need to really do a big increase in your wages, particularly at the lower end, because this is going to feed through. And particularly when if they see the big CEOs, owners of the business, driving around in fancy cars, still taking their overseas holidays, all that, these things can breed a lot of resentment. And this is what I'm worried about over the next 2 years. This is a very delicate moment, where the inequality and the social stability can take a big hit. And there is a responsibility at an individual level to do the right thing, which then replicated at a mass level can make a difference. That's my ending comment.
Thanks, Amal. Daniel, if you want to go ahead next.
Yeah, I'll be very brief. Basically, as Roshan pointed out, the playing field has been tilted towards benefiting those who are serving the domestic economy and importers. An opportunity has now arisen to potentially start exports. So what I would encourage all firms in the country is seize this opportunity, explore the possibility of hitting the global markets.
Yeah, so I want to reiterate some things that were said, I think, both by Amal and Daniel. It's regarding ideas, actually. I mean, whether we like it or not, ideas are very powerful, and wrong ideas can have devastating impacts on the economy and the country, as we have seen in the recent past. We need a mindset change. I'll quote from what the Indian Prime Minister Narasimha Rao said, actually, during the 1991 reforms. He said, we must get rid of the cobwebs in our mind. And I think that is very relevant. And I think this hopefully is where the private sector can play a part. We need to educate the public. We need to educate the public on the need for reform, on this transformation of the economy. And the pace of reform will depend on how much we can get everybody on board, or at least the majority on board. And I think the private sector can play a big role in actually building this public opinion, because we know that the medicine is going to be very bitter, it's going to be very hard, and we need to prepare the public for that. And I think that's where Amal's point also, where both from preparing people for a kind of belt tightening, but also cushioning the impact for the really vulnerable, are two things that need to be done. Because if we don't do these hard reforms, and I think this is the thing, we have never faced this kind of crisis. We've all kind of muddled through. We've always come out of some, a dip and we muddle through. But this is, I think, a point at which there's no muddling through, and we need to take this opportunity to do the hard reforms. Because actually, if we don't do the hard reforms, that's the other thing the private sector must be aware of, is we're going to have a mass exodus of people to countries that have undertaken this reform. And they're able to absorb this labor. So the biggest losers really will be the private sector, because you will lose all your good people. So I think so you need to also push, you need to prepare people, but we also need to push the authorities or the powers that be to make the right choices. Make the choices that benefit majority of the people and not work in the interest of some, lobby groups or certain vested interests. Because otherwise you're going to lose an entire generation. So I think that is, the message that I want to put out, that we really need to push for reforms. And I think that's again where the private sector can take a role, is to hold the government and all the other partners accountable for whatever these stabilization or structural reform programs. Otherwise, we always say, okay, the IMF will do the accountability. They will ensure that they will follow up. But I think it's up to all of us now to ensure that whatever stabilization program or whatever structural reform programs are in place, we hold the government accountable to following through on them. Because otherwise, we were going to continue. We're just going to, once we get out of this problem, it will be business as usual. And is that what we want? Finally, what is the objective? What is our objective in terms of the country and in terms of the economy? Thank you.
Thank you so much, Dr. Roshan. And I think a good note to kind of end in, a key message to the private sector brought about by everyone. So thank you to our speaker, Dr. Indrajit Kumaraswamy, former governor. Thank you, Daniel. Thank you, Murtaza, Amal, and Dr. Roshan for engaging with us. There was a question. There's a final question on the chat box saying we need an extended version, a discussion with the panelists. So maybe as the situation evolves, and I know the next few days, weeks, and months, the situation is so dynamic that conversations like this will need to continue as well, and we'll hope to host that as we go along. So thank you to everyone. Thank you to the audience as well. We've had quite a lot of you tuned in for the whole program, and to those who joined earlier as well, thank you, and to the viewers also on Facebook as well. Thank you for tuning in and sending in your questions, most of which I was able to take on. Apologies if some of your questions were not taken on during the discussion. So thanks to everyone, and have a great evening and the rest of the week.
Cheers. Thank you.
Thank you.